Buying a car through your business is probably the number one question I get asked as an accountant. And I get it. On the surface, it sounds like a smart move. You get to claim a tax deduction, claim the GST back, and it feels like the business is paying for your car. But here's the thing. You might hear the word tax deduction and assume that means you're getting a free car. And that's where the problems start. My name's Ben Elliott. I'm an accountant and a business owner. I've been helping business owners make smart financial decisions about their finances for over 13 years. Here's what I've learned. Buying a car through your business can be a great decision, but only if it's the right type of car, it's being used in the right way, and you understand the tax implications before you buy it. So I'm going to walk you through exactly when it makes sense to buy a car in your business, when it doesn't, and the 3 taxes you need to understand before you make that decision. The first thing you need to know is this. You can only claim a tax deduction for the business use portion of the car. If it's 100% business, you claim 100%. If it's 50% business and 50% personal, you can only claim 50%. Makes sense, right? Now, how do you prove that? With a logbook. A logbook is a 12-week record where you track every trip you take in the car, you write down the date, the kilometers, where you went, and whether it was for business or personal use. At the end of the 12 weeks, you calculate the percentage. Say you drove 10,000 kilometers during that period and 7,000 of those were for business. That's 70% business use. That logbook is good for 5 years. So you don't have to do it every year. You do it once and then you use that percentage for the next 5 years. Now, here's why this matters. If you're buying a car that's going to be used mostly for personal trips, like school drop-offs, groceries, and weekends away, and maybe 20% for business, you're probably better off keeping it in your personal name. But if the car is genuinely being used for business most of the time, then buying it through the business starts to make sense. For example, if you're a tradie and you're buying a ute that's going to be used on job sites, carrying tools, towing equipment, and parked at the depot after hours, that's a great candidate for a business purchase. The reason is simple. Commercial vehicles like utes are generally FBT exempt, which means you don't have to pay fringe benefits tax on them. You can claim the full tax deduction, claim the GST back, and there's no downside. Same thing if you're buying a van or a truck. If it's genuinely being used for business purposes, it should be in the business. Now, on the other hand, if you're thinking about buying a $200,000 Mercedes or a Porsche through your business because you heard that you can write it off, let me stop you right there. That's probably not a good idea. And here's why. There are 3 taxes that come into play when you buy a car through your business. Income tax, GST, and fringe benefits tax. Let me walk you through each one. I'll start with income tax. When you buy a car through your business, you get to claim a tax deduction for the depreciation of that car. Depreciation is just the decline in value of the car over time. The ATO says you can write off the value of a car over 8 years. So if you buy a $50,000 car, in the first year, you can claim about $6,250 in depreciation. The next year, it's a bit less, and so on. Now, here's the catch. There's a limit to how much you can depreciate. It's called the car depreciation limit. And for the 2026 financial year, it's about $70,000. So if you buy a $50,000 car, you can depreciate the full amount. But if you buy a $200,000 car, you can only depreciate up to $70,000. Everything above that is just dead capital sitting in your company that you can't claim. And there's a deadly trap with FBT. We're going to get into that later. So if you're thinking about buying a luxury car through your business, understand that you're not getting a tax deduction on the full purchase price. You're capped at $70,000. Now, there's one exception. If you're buying a ute or a van with a carrying capacity of more than 1 ton, it's classified as a commercial vehicle, not a passenger vehicle. And that means there's no depreciation limit. You can claim the full purchase price. So if you're a tradie and you buy a $90,000 ute, you can depreciate the full $90,000. That's a significant advantage. The second tax is GST. If you buy a car from a dealer and your business is registered for GST, you can claim the GST back on the purchase. That's 10% of the purchase price up to the GST limit. The GST limit is based on the depreciation limit. So for a car with a depreciation limit of $70,000, the GST limit is about $6,000. Let me give you an example. Say you buy a $50,000 car, the GST on that is $5,000. You can claim the full amount back. But if you buy a $200,000 car, the GST on that is $20,000. You can only claim back about $6,000 because that's the limit. So you're missing out on $14,000 in GST. Now, here's the other side of this. When you sell the car, you have to pay GST on the sales price, and there's no upper limit on that. So let's say you buy that $200,000 car, you claim back about $6,000 in GST, and a few years later, you sell it for $140,000. Now, you have to pay GST on that $140,000, which is $14,000. So you claimed back about $6,000, but you're paying back $14,000. That's a loss of about $8,000 in GST. So you really need to think about whether that initial GST credit is worth it, especially if you're buying an expensive car. Now, if you're buying a commercial vehicle like a ute, this is less of an issue because there is no GST limit. You claim the full GST back, and when you sell it, you pay GST on the sales price. It's a lot more straightforward. The third tax is FBT, and this is the one that can really hurt if you're not careful. FBT is a tax that a business pays when it provides a non-cash benefit to an employee or a director. And one of the most common benefits is a car. If you buy a car through your business and you use it for personal purposes, the business has to pay FBT on that personal use. And it's taxed at 47%. Let me show you how this works with an example. Say your business buys a $50,000 car, and over the course of the year, here are the costs. Depreciation is $6,000. Interest on the loan is $4,000. Registration, insurance, servicing, and fuel are another $10,000. So that's a total in $20,000 in costs. Now, let's say you use the car 50% of the time for business and 50% of the time for personal use. That means the personal use is a fringe benefit and the business has to pay FBT on that. And the FBT rate is 47%. Here's the problem. You bought the car to get a tax deduction. The company tax rate is 25%. So the tax saving on $20,000 of business costs is $5,000. But let's jump on the ATO FBT calculator and we're going to see what the FBT actually works out to be. All right, so we're going to pick the year as the 2026 financial year. Are you entitled to GST? We're going to click yes, and we're going to use what's called the operating cost method. Right? And when we put the costs in here of $20,000, we then need to put in the private use of the vehicle, right? So that was 50%, right? Employee contribution, there isn't one. And so when we calculate the FBT here, it goes through and it says here, your estimate of FBT payable is $9,776. So you're actually paying more in FBT than you're saving in income tax. But here's the trap with luxury cars. The interest and depreciation are much higher for a luxury car, and you can still only claim depreciation up to the car limit. But for FBT, there is no limit. So let's assume, back in the same calculator, that because of this, the operating costs of the car are much higher. Let's put in $50,000 because we're going to assume a higher amount of interest. The percentage of private use is still 50%, and we're going to calculate the FBT payable. You can see here that the FBT payable is a whopping $24,441. That's why FBT can be such a killer if you're not careful. Now, there are two main ways to reduce or eliminate FBT. Option one is pay the company back for the personal use. If the personal use is $10,000, you transfer the $10,000 from your personal bank account to the company. That reduces the fringe benefit to zero, which means no FBT. But here's the thing. You're paying for it with after-tax money. So you're not really saving anything. You've just moved money around. Option two is buy an FBT exempt vehicle. As I mentioned at the start of this video, certain vehicles are exempt from FBT. One is a ute or a van with a carrying capacity of more than 1 ton. If you're a tradie and you buy a work ute and it's generally being used for work purposes, it's FBT exempt. The other is an electric vehicle. If you buy an electric car and it's under the luxury car tax threshold, around $91,000 for the 2026 financial year, it's FBT exempt. So if you're thinking about buying a Tesla Model 3 or a BYD Atto 3 and it's under that threshold, you can buy it through your business, use it for personal purposes, and not pay any FBT. So when does it actually make sense to be buying a car through your business? Here's my general view. It makes sense if you're buying a ute or a van that's genuinely being used for work purposes. It's FBT exempt and there's no depreciation limit, and you claim back the full GST amount. It makes sense if you're buying an electric vehicle under the luxury car tax threshold. It's FBT exempt, so you can use it for personal purposes without paying FBT. And it makes sense if the car is being used mostly for business and you're comfortable with the FBT on the personal use portion. It doesn't make sense if you're buying a luxury car above the depreciation limit of $70,000. You're not getting a deduction on the full purchase price, and the FBT can be a deadly trap. And it doesn't make sense if the car is being used mostly for personal purposes. The FBT is going to cost you more than the deduction is saving you. So, in a nutshell, buying a car through your business can be a great decision if it's structured properly. You can get a tax deduction, claim the GST back, and if it's the right type of vehicle, you can avoid FBT altogether. But if you don't understand how these three taxes work, you could end up paying more than you're actually saving. The tax system is designed to let you claim legitimate business expenses. And if your car is genuinely being used for business, buying it through the company can make a lot of sense. So before you go out and buy a car in your business name, make sure you understand what that actually means. If you're thinking about buying a car through your business and you're not sure whether it makes sense, book a call with us. We'll sit down with you, look at your situation, work through the numbers, and make sure you're making the right decision. Links in the description below. I'll see you in the next one.